Hello again, traders. Doing Trader once again from DRFX, Swing Trading Mentoring. Going to be taking a look at the situation now on the New Zealand Canadian dollar, which is continuing the strong bearish trend in favor of the Canadian dollar as it makes its way down towards the major support target. So I'm going to be taking a look at the daily chart and the forward chart, and specifically the forward chart, to see if the market can present us with trading opportunities and entry setups that could take advantage of this downtrend. Now, quickly, just to give you a quick overview of the method and approach to identify market direction and trading opportunities. What is basically done is to examine the daily chart and the forward chart by using the candlestick signals, trend lines, and consolidation setups to determine market direction. So what we do is identify whether or not the market is trending or moving in a sideways pattern in consolidation, and then determine if the market can provide us with trading opportunities in either of those market setups. Once a trading opportunity has been identified, entry then takes place using the signals provided by the forward chart for the most part. In some cases, we'd also trade the signals provided by the daily chart, but in most cases, the opportunities that we see in the market, based on my methodology, generally provide us with more entries based on the forward chart. Now, if entry takes place based on a forward chart, that time frame is going to be the one that we use for stop loss placement to protect the trade. However, if the stop loss is too far away, we would then go down to the 1 hour chart and look for a stop loss area on that time frame. If entry takes place based on the signals provided by the daily chart, then we would only use the stop losses that are provided by the forward chart. So that's it in terms of the overview, in terms of how we identify market direction on the daily chart and the forward chart. Basically using candlestick signals, trend lines, and consolidation setups. Now, since the New Zealand Canadian dollar is in a strong downtrend, we're going to be basically taking a look at how we go about identifying trading opportunities when the market is in a strong downtrend. Now, having identified that the particular currency pair that you're looking at is in a strong downtrend on its daily chart, what we would then be doing is to trade the movements bearish until the market reaches a major support point. So what we will do is essentially trade bearish signals that indicate the market is continuing the bearish movement after the market has temporarily pulled back. Now, when the market temporarily pulls back at this area here near to its trend line, it will do one of two things before resuming the downtrend. It can either move sideways for a little bit in the form of a small consolidation, either on the daily chart or the forward chart, or it can actually pull back and form a small counter trend line setup before U-turning and continuing the bearish movement. Now, if it is moving within consolidation, the recommended option in terms of trades is to trade the bearish waves at resistance down towards support, as well as the breakouts that take place below support. The reason for this is that the bearish signals that are associated with these movements are going to be more reliable and stable because they would be in sync with the main trend direction. So what you find with the market is that as long as the signals are in the same direction as the existing downtrend, as the existing trend direction, you will have a lot more liquidity and a lot more trading volume supporting those signals, because the overall momentum and the majority of traders are actually trading in the direction of this trend. So that is why trading against the trend is always risky, because the movements that take place against the trend direction usually have less volume and less support, and so the signals that are provided are weaker and thus less reliable and therefore more volatile. So the recommendation is to avoid bullish movements against the main downtrend and only trade signals that are in sync with the main trend direction. Now, as you can see on the daily chart, New Zealand Canadian dollar has been in a strong downtrend for quite some time, stretching back to 2018. So a strong downtrend that you can see here that was also started by this double top formation and is expected to make its way lower and eventually hit this support target of 0.83198. So this is expected to be the support target that will at least temporarily end the downtrend. And so trading towards this direction here should provide us with trading opportunities and trading gains before the trend finally comes to an end. Now, taking a closer look on the daily chart, you can see that the downtrend has been moving steadily. You can see that the candles have been fairly weak to basically indicate that there's not a lot of, well, even though this is the main trend direction, there's not a lot of aggressive selling with this on this currency right now. So that is why the candles are fairly small and ordinary. But nevertheless, it is really just saying that the market is going to be taking a longer time to hit its target compared to if the candles were a lot stronger. So nevertheless, the expectation is that the market should eventually reach the support target. And so the better option in terms of trading would be to always look for trading signals that are bearish as the market makes its way lower. So that's the daily chart. And the 4-hour chart, as we had looked at a couple of days ago, had provided us with this pennant consolidation setup. And so the expectation was that the market would eventually break below the support boundary and provide us with bearish signals, both to trade as well as to indicate the continuation of the movement towards support. Now, as you can see here, the market did in fact break out below support, but it's kind of doing it in a volatile fashion that makes it a little bit risky. So you can see that initial breakout took place with this candle, but not enough of that candle broke out below the support target, below the support boundary, for it to be considered a strong breakout signal. Normally with breakout candles from consolidation, the majority of the candle, I would say at least 70% of the candle, should have broken below the boundary that we're breaking out of. So as you can see, this is just a little bit under 50%, or just over 50%. That has closed of this candle, that has closed below the support, which is not enough of an indication that the breakout has actually started. So there's no surprise that the market pulled back. And if you had placed your stop loss above the high of this candlestick formation, you would have been stopped out and would have incurred this initial trading loss. Now, what happens from time to time is that the market does initially break out and then pull back, and then U-turn to provide us with another breakout signal that would continue to break out in the intended direction. And so you can see that this is exactly what took place. But the reason why I would not have traded this is because of how fairly ordinary this signal is, and the fact that not much of it actually broke up below the support boundary. So for the same reason why this was volatile, why this was risky, and why this signal was stopped out, we're also seeing the same situation here with this candle, where not enough of the candle actually broke out below the support boundary. But nevertheless, it is actually leading to the breakout bearish, as you can see here, right? So this is not a situation, this is not a trade that I would have entered at because of the risk associated with this candle. Now, as you see, the market is responding to the signal and is breaking out lower. So it is possible that an entry at this area could take place, and your stop loss will be placed above the resistance of the support of the pennant. But if I'm trading candlestick formations, I always prefer to get to trade and enter the market with a strong candlestick formation. So right now, even though the market is moving bearish, none of these signals is the one that I would normally rely on. And I think right now, because of the fact that we're approaching the Labor Day holiday in the US, there's a little bit of smaller volume. And so this is why the candles are probably like this right now. So my preference would actually to wait on something like this, where the market pulls back and then provides us with a strong bearish engulfing candlestick formation. So I wouldn't be entering the market right now because of the possibility that, given how weak these candles are, it could pull back and take out these weak candles before U-turning and provide us with a stronger bearish signal. However, nevertheless, since it is a breakout from consolidation, and we did in fact see a U-turn signal that is leading to the movement bearish now, the market could simply just continue on its merry way with additional bearish candles without any pullback taking place before hitting support. So those are the two possibilities in terms of how the market could continue this bearish breakout from this pennant consolidation setup as it makes its way down towards support. But as I said before, I would be hesitant about entering the market right now because of how weak these signals are, and as well as because how ordinary this signal was. So because of how ordinary this signal was and because of how weak these signals are, there is a possibility that the market could pull back and then provide us with another U-turn to continue the movement, which is actually what I would prefer in terms of a stronger and more reliable entry signal. Of course, a bearish engulfing candlestick formation is one of the signals that we would look for as part of the downtrend. We could also see an ABC signal as well as an evening star that could be formed before the market eventually reaches the support point. So when we're trading in a particular direction, very important to identify the types of candlestick signals that we're going to be looking out for that can provide us with the best entry to take advantage of the movement towards a particular resistance or support target. So that's it in terms of the summary on the New Zealand Canadian dollar, the forecast and analysis for this currency pair. Strong downtrend on the daily chart that is taking us towards a major support point, and the expectation is that that should be hit within the next 24 to 48 hours as the breakout from the small consolidation set up on a 4-hour chart continues bearish and could possibly provide us with trading opportunities. As I said before, the candlestick signals so far are fairly weak and not the type that I would prefer to trade. And so my preference would be to wait until the market pulls back and then U-turns and provide us with a stronger bearish signal. So if you have any questions, you can let me know by emailing me at shepherdwayne@gmail.com. You can also find me on Facebook and BabyPips using the same username DRFX Trading, Twitter at Worldwide876, Instagram at DRFX Trading Boss, as well as on my website swingtradingmentoring.com, where you'll find a full description of the trading methodology that I now use, including descriptions of the trading manual, which forms the foundation of my methodology, trading signals, video lessons that form part of my 3-month mentoring service, as well as my Skype mentoring service that is also provided for my VIP clients over a 6-month period. So until next time, traders, happy trading and all the best.